Hello, I am PRAMOD KUMAR and today we will study. Subject is accountancy. Our chapter is analysis of financial statements. We have divided this chapter in 4 parts and right now we will discuss part 1 of 4. In this part 1, we will discuss meaning, everything we are talking about analysis of financial statements, its meaning, significance, objectives and tools available for analyzing this, and those tools are comparative statement, common size statement, trend analysis, ratio analysis and cash flow analysis, right? So first we will know, when we talk of analysis of financial statements, primarily which are the statements we are talking about? We are talking about a statement of profit and loss, and we are talking about balance sheet, right? Primarily these two things we are talking when we are talking of analysis of financial statements. Now we come to analysis, right? What is analysis? Or a statement of profit and loss and balance sheet. These are summarized financial reports. These are summarized financial reports providing financial position and operating results. Financial position and operating results of a firm, any firm or any company of a company, right? In these two, detailed information is provided which is contained in these statements, and they are useful. Those detailed informations or piece of information are useful for assessing. We assess the operational efficiency and financial soundness of a firm or a company, and this requires proper analysis and interpretation, right? So whenever we talk of the word analysis, it includes both analysis as well as interpretation. Analysis without interpretation is of no use. See, we have been given a set of data in the form of a statement of profit and loss, balance sheet. So unless we analyze, how do we know how the firm is doing? What are the operating results? What do they indicate? What is the financial soundness of the company and what does it indicate? So we analyze, right? So regarding analysis, it says analysis of financial statements. It is a process of critical evaluation. Analysis is a process of critical evaluation of various data, facts and figures provided in these statements. A statement of profit and loss and balance sheet. Critical evaluation of set of data provided in these statements, right? And for what purpose that is done? That is done in order to understand and make decisions. We analyze with a purpose to understand and make decisions regarding operation of the firm, right? That is called financial statement analysis or analysis of financial statements. It is a study of relationships among various items provided in these statements. A study of relationships among various financial facts and figures provided in these statements, right? And those facts and figures provided in the statements gives us an insight. They give us an insight into the operational efficiency and financial soundness of that particular firm or company, right? What is the operational efficiency and what is the financial soundness of that company? Financial health, operational efficiency, and depending on that we come to know what are the future prospects, how the company is going to do in the future, right? Then we have already said financial analysis includes analysis, interpretation, right? Analysis, what is analysis? It is simplification of various data, facts and figures provided in these statements. And that simplification we do through laid down methodological processes. There is a method, there is a process to analyze, right? Or there are methodologies, there are processes to analyze these statements. Simplification of financial data by methodological classification given in financial statements of various facts and figures, right? What is interpretation? Through interpretation, what does it do? It explains the meaning and significance of the data provided or furnished in these statements. What is interpretation? Interpretation is explaining the meaning and significance of various sets of data provided in this, furnished in these statements, right? Meaning and significance we come to know through interpretation. So analysis without interpretation is useless. Interpretation without analysis is almost impossible, right? Then we go ahead. Financial statement analysis. Now the question arises, what is the primary objective of financial statement analysis, right? What could be you can just think over. It's very simple. You think yourself that you are an investor. You are investing in the shares of some company. So what could be your objective? Obviously, as an investor, your objective will be to know the earnings of the firm, right? You have invested. Why have you invested? With the objective of earning some money. So as an investor, your objective will be to study the earnings of the firm, right? Main objective. You could have other objectives also. You would like to know whether this company has long-term profitability prospects or long-term sustainability, whether it will sustain for a long period so that you can keep invested your money for a long period, right? The primary objective of analysis of financial statements is to determine best possible estimates and predictions. Why do we analyze? To know the best possible estimates and predictions about future conditions. What is going to happen to them? We analyze a company's these things for knowing what is the current position and what do we expect, anticipate, predict for the future depending upon this analysis, right? In light of the point of strength and weaknesses, the analysis of these statements will throw to us strengths and weaknesses of the firm, and depending upon those strengths and weaknesses, what we will do? We will make decisions about future, right? And it will help us in decision making, whether we intend to remain invested or we intend to come out, right? Now we go to significance of analysis of financial statements. Meaning we have discussed, now we will go to significance. See, what is the significance of analysis of financial statements. Nature of analysis of financial statements. Nature of analysis of financial statements will depend upon the purpose of the analyst. If you are analyzing from the viewpoint of investor, your objective will be earnings of the firm or long-term profitability of the firm, right? So here we will discuss seven things. Significance from the viewpoint of finance manager. Every company is having a finance manager. Top management. Third is trade payables who sell to the firm on credit, without cash, on credit. Fourth, lenders who lend to the company. Fifth, investors, which we have discussed. Sixth, labor unions, and seventh, others. So, in case of a finance manager, what is the objective? What is the significance of finance manager? Finance manager of a firm or a company would always like to know about the financial control exercised in the firm. He needs to control finances of the firm, right? And to make rational decisions depending upon the analysis of what are the outcomes of the analysis and interpretation of the statements, right? And it also helps the finance manager in determining continuity of operating policies, whether the current operating policies need to be continued or they need to be modified or they need to be changed. It helps the finance manager in taking those decisions. It also helps the finance manager in taking a decision about investment value of the business. He keeps on assessing what is the investment value of our business, whether it has gone down, come up, or remained the same. And testing of efficiency of operating policies. A finance manager keeps on testing from time to time the operating policies, right? Credit ratings. Every company keeps on getting rated through one or two credit rating agencies. So what is the credit rating of the company? Whether it has gone down, improved, or it has remained constant, right? And it helps the finance manager in seeing the deviations so that some corrective measures can be taken, right? Second, we come to top management. Top management of any firm or company is responsible for ensuring two things at least. First, whether the resources of the company are being optimally utilized in the best possible way, and to ensure its financial soundness. Top management, it is the responsibility of the top management to ensure that the resources of the company are optimally utilized in the best possible way. There is no wastage. And second thing, to ensure its financial soundness, right? And they also, depending upon the analysis of these things, the top management takes a decision upon appraising the individual person's performance in the company, right? They appraise the individual performance. Suppose I am working under top management, so they will appraise my performance, what I have done during the last 1 year. And top management also keeps on evaluating systems of internal control, whether the systems of internal control are working or not, whether they need to be continued like that or modified or changed, right? Third is trade payables. There are several firms which sell to the company on credit. So, trade payables will be interested in knowing what is the short-term liquidity position of the company, whether the company will be able to meet its short-term obligations on time or not. Along with short-term liquidity, they are also interested in long-term liquidity, because if a company is finding it difficult to service long-term debt which they have borrowed for 3, 5, 7 years, naturally after some time the company will find it difficult to serve short-term debt also. So trade payables who sell on credit to the company will be interested in knowing about the liquidity position of the company, whether the company will be able to honor its short-term obligations, right? Then we come to lenders. Lenders are those who have financed the company for long-term debt, 3 years, 5 years, 7 years, 10 years. So they will be interested in knowing about the profitability and solvency of the company. What is profitability? Profitability is net sales profitability is profit after tax upon sales into 100, right? So long-term lenders will be interested in knowing profitability of the company and its solvency in the long term. What is solvency? Solvency is the extent to which assets of the company cover commitments of payment made for future, right? What is solvency? Extent to which assets of the company cover commitments of payments made for future, means liabilities. To what extent the assets of the company cover the liabilities of the company. So lenders will be interested in knowing the profitability, continued existence of the company, survival of the company and solvency, right? Because they have lent for long term, 3, 5, 7, 10 years. And they are also interested in knowing about the capital structure. Who are all who have invested in the capital of this company, right? Then investors. Investors we have already discussed, they are interested in earnings of the firm and they are also could be interested in long-term profitability so that they could remain invested for long term in that company, right? Then labor unions. Labor unions will be interested in the analysis of financial statements of the company from the viewpoint of knowing whether an increase in wages is possible, and if increase in wages is possible, whether that will be through increasing the productivity of the workforce or increasing the price level. See, a firm can pay higher wages to the labor union or laborers only when it earns more or saves more. Either earns more or saves more or both, a combination of both. So what will happen? Labor unions will study it, analyze it from the viewpoint of knowing whether they can raise a demand for increase in wages, and if yes, whether the increase in wages will be supported through increased productivity of operations or increase in prices, right? Then lastly, seventh item is others. Who are others who will be interested in the analysis of financial statements? Economists. Economists want to know what is the current position of the company and what is the current economic environment. Researchers, people who research, they will be interested in analysis of financial statements of a company. Government needs to regulate prices of several items, and government also needs to earn through taxation. So government could be interested in analyzing the financials of a company mainly from the viewpoint of regulation of prices and taxation purposes, right? So we have seen the significance. Now we come to objectives. What are the objectives? It's very simple. You just think that you are an investor. So what will be your objective about the analysis of a company? This thing we have discussed. You are a lender. What will be the objective? You are a trade payable. What will be your objective? You are a labor union. What will be your objective? You are a finance manager. Then you are top management. You are an economist or a researcher or the government. So, the main objective of analysis of financial statements of any company or all companies will be knowing about their current profitability, right? Long-term profitability, their capital structure. Why capital structure? So people can know who are the people who can influence the investment decisions of the firm, right? Or who can take decisions about the various aspects of operations of the firm. So, to be more specific, the objectives of analysis of financial statements will be to assess the current profitability and make estimates predictions about the future profitability, to ascertain the relative importance of different components of financial position of the firm, different components of financial position, to identify the reasons for change, deviation, and to take corrective measures wherever required. When we analyze, we come to know the trends or deviations. What is deviation? What is deviation here? Suppose we estimated that sales will increase from 100 to 125, but in actual it increased from 100 to 105 only. So there is a deviation. We estimated that the sales will increase for 100 to 125, but increased actually from 100 to 105 only. So there is a deviation in our estimates, whatever the estimates we made vis-a-vis actuals. So it will help us analyze what are the reasons for this deviation and what are the corrective measures that can be taken for future, so that such deviations are not there between estimates and actuals, right? To judge the ability of the firm to repay its debt and assessing the short term as well as the long term profitability, sustainability of the company, right? Now we have discussed objectives also. Now we will discuss tools. There are various tools available to us. For what? We are talking of tools. Any person needs tools for certain purposes. So, for what do we need tools here? We need tools here for analyzing the financial statements of a company. So, what are those tools? Tools of analysis: comparative statements, same size statement, common size statement, trend analysis, ratio analysis, and cash flow analysis. There are 5 tools, 5 major tools. There will be many more. There could be many more. But right now we will study 5: comparative statement, common size statement, trend analysis, ratio analysis, and cash flow. So what is comparative analysis? It's very simple. Comparative statement is very simple. Suppose I am a firm, company ABC Limited, right? I am a firm, I am a company ABC Limited. So what is comparative statement? If I compare the balance sheet and or the profit and loss statement for 2017-18, 2018-19, 2019-20, what I do? P&L. So I am comparing profit after tax. Here it was 100, it became 103, and then it became 98. So here I am comparing profit and loss account of this company ABC Limited over a period of last 3 years, 17-18, 18-19, 19-20. So it gives us an idea. It gives us an idea how the financials of the company have moved, either the profit and loss account or balance sheet or both, how they have moved. So over a different period of time it compares. So by comparing we come to know in which direction the performance of the company is going, or what is the trend, whether the trend is increasing or whether it is decreasing or whether it is constant. The second one is common size statement. What is common size statement? Common size statement means, suppose we take the balance sheet of a company, right? And what do we do? Suppose the size of the balance sheet is 17,500, right? Size of the balance sheet means assets are 17,500, liabilities are 17,500. So these we convert into 100. We treat this 17,500 as 100 and all other items of the balance sheet we represent as a percentage of this, right? Total balance sheet size is 17,500. We treat this 17,500 as 100. So suppose creditors is 1750. So what shall we write? Total is 17,500 is equal to 100. So this is 1750. So it is 10%. Right? And suppose here cash balance. Cash balance is 175. So what it is? It is 1%. Right? So this is called the size of the balance sheet or the size of the revenue we treat as 100, and all other items of the balance sheet or profit and loss we treat as a percentage of this. So if creditors is 1750, we write 10%. If cash is 175, we write 1%. Right? Common size. Third we go to trend analysis. What is the trend analysis? It only shows what has happened over a period of time. Right? So for trend analysis, we need profit and loss statement and or balance sheet for a number of years, at least more than 1 year. It could be 2 years, 3 years, 4 years, 5 years, to know the trend, how the various items of balance sheet or profit and loss are moved over a period of time. So from the trend analysis, the management can know in which direction the financial position or the operating performance of the company is going, and by seeing that trend they can take a decision to continue the existing policies, principles followed, or to modify them or to change them altogether. Right? Trend analysis. And then ratio analysis. What is the ratio analysis? It describes the significant relationship that exists among various items of the balance sheet or the profit and loss account at both. It describes the significant relationship that exists between various items of the balance sheet and the profit and loss statement. Ratio. So the various ratios could reveal so many things, right? Like profitability, right? Solvency, these kind of things. Liquidity ratios, how liquid the company is in meeting short-term, long-term obligations. It is possible to assess the profitability, solvency and efficiency of operations through various ratios, right? Then we come to cash flow analysis. What is cash flow? How the cash has come, how the cash has gone out come is inflow and this is outflow, right? How the cash has come into the business, how the cash has gone out. So it also, cash flow statement gives an insight how cash has been used in the business, from where it has come, how much it has come, where it has been used and how much it has been used, right? Cash flow statement is prepared to project the manner in which the cash has been received and has been utilized during an accounting year, as it shows the sources of cash receipts and also the purposes for which payments have been made. If inflow is more than outflow, we have a cash surplus. If outflow is more than inflow, we have a cash deficit, right? So people also are interested in the cash generation of a company, how cash is generated and how much it is generated, whether it is sufficient or insufficient, right? And how it is utilized. So I hope you found it easy to understand. In case of any difficulty, you may please approach me on my email ID, which will be there at the thumbnail to the video. Thank you very much.